Hi, everyone. Welcome back to our How to Survive and Thrive Through Real Estate Virtual Summit. I am super excited to have with me now Alia Carter, who is an expert in self-storage, which is another asset class I think is poised to do particularly well. It's a recession-resistant investment or asset class. It's a type of asset class that often can do better when times are down. So I'm super excited to have her. Welcome, Alia.
Hi, thank you so much, Monique.
Thank you. And thanks in particular, because I know you have a very you have a lot of self-storage facilities, you have a busy business, and you have twin baby girls.
Yes.
So how old are your girls now?
They're 5 months, and we also have 2 teenagers. So in addition to the twins,
all in the house,
we're attempting to do this. Well, it's week right now. I guess next week technically starts the homeschooling process, but it's been exciting.
Yeah, yeah. So yeah. God bless you for finding the time to be here, because you are the definition of busy. I looked it up in the dictionary. There was your picture. So I appreciate you being here. So you have some slides that you prepared to talk about the just talk about self-storage, and so let's go into your slides, and then we'll talk a little bit about what is happening right now in the niche, because things are changing so quickly with what's going on in the economy, and then we'll also talk about like how do you keep that psychology piece too. So but let's go into your slides.
Okay, that sounds great. And just for the audience here, I will just mention that at the end I'm going to talk a lot about this, more of the timeliness. So if you're kind of have that question hanging, what do I do? Is this something I should do now? I'm going to address all of that. I'm first going to go into kind of who we are and what we do, and then dive into more of the timely stuff towards the end. So thank you for that introduction. My name is Alia Carter. I am a co-founder of several organizations, including Investors in Action, which is a lending company, and I'm also a co-manager of the Capital Storage Fund. So with our team, we currently own about 15 properties. And I say that because Al, our operational partner, he came into our business, or we came into his business rather, where he owned a couple properties already. So we just kind of look at the whole portfolio a lot of times when we're doing business. My background is in fundraising, private lending. I'm personally a connector. I like to put deals together. I like to put people with deals, and our investors, I go out and do a little bit of networking and marketing. Now it's all online, right? But I really enjoy connecting with people and helping them thrive in whatever cycle we're at in the real estate market. So we're in very interesting times right now, and it's both challenging and exciting potentially as you look towards the future. And I have a pretty good scope of, kind of where the market's gone in other recessions and why this asset class is so great. We're currently focused on self-storage. So we've done lending to fix and flip investors. We've done buying of notes, both performing and non-performing notes. But right now we're really, really happy to be involved in self-storage because it has an element of resistance to market corrections and ups and downs. So again, what we do, Terry and I are part owners in 14 self-storage facilities. I believe we have 16 altogether, including Al's other ones. And we focus on secondary and tertiary markets. So we're not in the major metro areas. We're really looking at smaller places. Usually, there's an airport within 30 to 40-minute drive of our properties, but they're not the major metro areas. And we find that there's better deals there, as well as less competition and less overbuilding, which is something that's been kind of something that's hit our sector over the past 5 years. We look for value add storage properties, and we raise money from private investors. We turn them into profit centers and either flip them or hold them for long-term cash flow. So the majority of our portfolio we currently have was purchased with a long-term vision. The properties that we're getting ourselves into at this moment in time, we're really looking for that dual strategy of being able to sell it, or if we decide to change our mind and hold it, we can do that as well. So what I'm sharing today is our business model and why self-storage is recession resistant or resilient, how to add value to your storage business. So I'll share with you an example of one of the deals that we've done, and answer the question, is this the right time to buy? Should we start buying currently? I want to talk about the critical steps to survive and thrive in the real estate market in general. So not just specific to self-storage, but things that you can do as an individual, somebody who wants to invest, or somebody who's already investing, where you currently need to kind of put your money in this current time, and then also how to contact us, of course. So we look for value add properties. And there's a number of elements. So many people might be familiar with a fix and flip transaction. We look for slightly different things because it is a commercial property and has multiple tenants. We look for some slightly different things. So we're looking for things that we can easily fix. One thing, and our favorite thing to fix, is the marketing. We've bought properties that didn't have an online presence, they didn't have a website, they didn't have a SEO friendly or cell phone, mobile friendly website component. And that's really a big miss, because the majority of people, especially now as we're going into our homes and we really can't go out to the storage facilities, we're looking on our cell phones or on our laptops for that next unit. And so poor marketing is a very easy thing to fix. It's a very inexpensive thing to fix as well. Poor management. So we look at our managers. Typically when we acquire a property, we'll work with the existing manager for a period of time, work with them to implement our strategies and our ethics and our values. And if they don't seem to be aligned with how we do business and aren't adding, to what we're up to, then we start looking at ways to replace the management. But we oftentimes try to work with the existing person, because sometimes it's a symptom of the previous owner not paying attention to their property, or not paying attention to, or providing proper instruction to their managers. We almost always buy lower occupancy properties. Typically the occupancies range in the 40 to 70% range. And that gives us an opportunity to work within the market to increase our occupancy and add value that way. We look for low market rents. So some of the properties that we've purchased may have been above 65% occupancy, but they hadn't updated the rents for a really long time. A lot of the tenants were, $10, $20, $50 in some cases below market rent. So we were able to go in and slowly correct the existing tenant base up to something closer to market rent. Deferred maintenance. This is something that we prefer not to have a lot of deferred maintenance, especially if it's expensive deferred maintenance. You've got lots of units. So let's say, for example, it's the exterior or the asphalt or the roof. Those are things that we prefer not to have as a major repair item, at least within the first couple of years. But there are certainly things that, like a handful of roll-up doors might be preventing the facility to have full occupancy. So if those are out of order, those are easier and less expensive things that we can go in and fix. Sometimes it's as simple as adding more fencing or improving the roll-up gates out in the front. And underutilized outdoor space is a big one. We work with U-Haul as kind of a partnership, and when they bring the trucks in, suddenly we have some name brand recognition at our facility. So not only do we get an online presence, but we have those big orange trucks and sometimes the signage where people can drive by. They might not have even noticed the self-storage facility before. Suddenly something new is there that is familiar to them. Most people know of U-Haul. And in addition to that, the U-Haul rentals attract new tenants because new tenants are thinking about moving. So if they're moving to us, then logically, if they're looking for a storage facility, they'll probably choose our location just out of convenience, because that's where they're bringing the U-Haul. So U-Haul is a big one. Vehicle rentals, if you have lots of land on your property that's being unused, you could rent to trucking companies. We have a contract at a couple locations with trucking companies. You can rent to individuals who have boats, RVs, extra vehicles that they're looking for. So that underutilized outdoor space is critical. Ancillary income. So what I mean by ancillary income, it's an extra bottom line item, such as boxes and moving supplies, tape, mattress covers, blankets for moving, those types of things, extra locks. Those are all things that, you know, maybe you're adding an additional $30 to the move-in cost by selling those items. But if you had each customer do that, over time, that really adds up. So those are nice things to have, and make sure that all of our location facilities have those sales items. And also, we're looking for mom and pop type of ownership, not necessarily a hedge fund who really has, you know, slick advertising and all their pieces put together. A lot of times these are from individual owners who might only have 1 or 2 properties. They might be retiring. A lot of times we've got a deal in escrow right now where literally the owners, they just want to go golfing. It's a bunch of older gentlemen and they just want to go golfing. They don't want to mess with this. They heard that self-storage was a good way to make money and kind of a hands-off way to make money. Well, they didn't realize how much there actually goes into managing it. It is more of a hands-off type of asset class, but it's not 100%. You still have to manage your managers. And if you don't have a system in place to do that, then your facility might not be optimized in running well. So, you know, those are all opportunities. The other reason why I like mom and pops is because if they're used to getting that income from the storage facility, they can continue getting income, maybe make a profit off of selling something that they've had for 10 or 20 years, and do a seller carry finance. So a lot of times we're negotiating seller financing, and that's really attractive to us. So we don't have to deal with banks. We don't have to deal with all the underwriting that goes along with a bank, and that just takes up extra money and time when you're purchasing a property. So those are reasons why we like the mom and pops. So those are a few things that we're looking for. Let me share with you just the top 10 reasons why we love storage. And I'll start with probably the most important factor in this market today. It's recession. I call it recession resilient, recession resistant. You still might have a dip in the market. You still might have an increase of delinquencies. And we actually expect to see a little bit of that. But if you're comparing it to, let's say, office space or even some single family home rentals, Airbnbs, like those are getting hit really hard right now. So this is one reason why we just love self-storage. The need for self-storage increases when you have an upheaval in the market. People are moving, they're consolidating households. We saw a spike in the middle of March where the colleges were shutting down. And so we had 1 or 2 locations that were near a major university, and we did see a spike of about 5% of our move-ins. And we've never seen that before at that property other than the summertime. So we got those students in a little bit early. Businesses, you know, certainly when you have such a massive economic disrupt like we're having, a lot of businesses might go out. They might be shrinking their footprint in an office space or in a warehouse location, and they might need cheaper space to inventory their items. So if they're used to paying $3 to $5 a square foot, now they're paying, you know, something closer to $1 a square foot to store all those items. So they can do that within a storage unit. We have a very diverse tenant base with a low cost of rent. So let's say you live in an area where your apartment costs $1,500 a month, your storage unit might cost $100, $150, maybe even cheaper than that, depending on the size of the unit. So people are interested in making sure that their stuff isn't auctioned off, and they're willing to pay that extra $100 to ensure that their items are safe and secure and put in a place that when a better day comes around, that they can just pull it back out and move to a larger home. So that's one reason. And you have, of course, at each location, hundreds of tenants instead of one single tenant in maybe a single family rental. We have lower maintenance and operational costs. So that's a key thing. Usually about 50% occupancy pays for all of your expenses and your bills. So if you happen to have a drop in occupancy, then you can still kind of maintain all of your bills with that. We have the U-Haul moving trucks. Those are certainly needed. We've seen a spike in several locations regarding moving. We've heard from a few people, I don't know if they were coming from New York or if they were coming from Wayne County in Michigan, but we had a number of people move into some of our slightly more rural locations because they were trying to escape the virus. Hopefully that worked out for them. But you know, a lot of fear is going on right now, and it's driving people to make rash decisions such as moving. And so we're seeing an uptick in almost all of our locations that have U-Haul rentals, with the moving trucks specifically. The purchase of boxes and moving supplies go along with the moving. Retailers shifting from brick and mortar to online sales. So we're probably not seeing that yet. This is an overall trend that's been going on for about 15 years now as eBay became more popular. But I think when you have this, again, this upset where people don't want to, they're fearful of interacting face to face, of going into stores, of touching merchandise. Amazon is booming because people are going online to make their purchases. So we might see that with some smaller retailers as well. And they might need extra space to put those, that merchandise. And then we have lower costs per square foot for business operations. So if people can store for a cheaper cost per square foot, then that's beneficial. And we're considered a counter-cyclical asset. So when the market goes like this up and down, then we're a little bit more steady, or a lot more steady compared to certain different asset classes. So here's I have a couple slides related to this, and you can see in the middle of this slide, this is from Public Storage, taken back a few years, but in 2009, 2010 is when they were experiencing the dip. And if you looked at this chart and you compared it to a lot of other different type of asset classes, I mean, this is really not substantial. If you look on the left side, that's the occupancy. It went from about 91% to 89%, and then it, you know, of course, shot back up to the mid-90s after things started improving. But there really wasn't a massive disrupt here. Same thing with the rental rates. The rental rates dipped in 2009, 2010, and then they recovered a couple years later. So that was really important to consider. This is just another chart off of neighbor.com that I found, and these are storage unit occupancies by surveying a broader scope of storage facilities. So you can see that there was a dip, but you know, it wasn't 100% dip like you would have with a single family. It wasn't a 50% dip like you might have with office space. So it recovered a lot faster, and you can see, I mean, it shot right back up too. High demand, in general, this is a generalization, but this is the fastest growing segment of the commercial real estate industry, has been for the past 40 years. We've had historic occupancy rates in recent years in the 90+ percentile, and the demand outweighs supply in many markets. Now that has shifted a little bit in the major metro areas, places like Dallas and Sacramento. Those are areas that you might want to stay away from, but you have to research each location very carefully, making sure that the need, the demand is there for what you have supply. Peaceful tenants. So here's a snapshot of who our tenants are. I guess they're not the ones that are actually paying the bills, but this is typically what you would see if you rolled up the door for a storage unit. It's just a lot of stuff, you know. So right now people aren't going out. They're not really coming to the storage facility unless they're in dire need of something that's in there. So you don't have the same foot traffic that you would for most other types of asset classes, and that makes for quiet tenants in general. This is an example of a broom swept unit. so unlike apartments, unlike homes, unlike mobile homes, where you might have to spend tens of thousands of dollars rehabbing from the previous tenant, changing paint and carpet, you know, we've got concrete floors, sometimes brick or concrete walls, steel walls. In this case, there's drywall, but that's pretty unusual. We typically have a very easy time cleaning out a unit. Within minutes, it's cleaned out, broom swept, and ready for the next tenant. So that's always nice. I think I kind of hit on all of these too. Less interaction with tenants, just the manager has an easy time facilitating the next rental. And so you could have one manager facilitating rentals for a 300, a 400, a 500 unit facility. We usually run about one full-time manager and one part-time manager for hundreds of units. If you were considering an apartment complex, you would probably have several managers for that many units, or you know, maybe one manager for like 20 units, let's say. So we can spread the cost of management across many, many tenants. The ease of dealing with delinquencies. And so right now, there's a big question of, can you evict people? We are currently putting a moratorium on all evictions that are happening within our storage facility. It's run on a state-by-state basis. In general, though, there's far fewer rent regulations. We don't have the same tenant rights that other facilities would, that have people living in the units. So that's a big thing why we like this, because if somebody is late, we can start the auction or eviction process within days of them going late on their rental payment. What we do is we put a management overlock on their unit, and then we run a storage war. Now, you guys might have seen the show Storage Wars. It's a little bit like that. Actually, we've moved everything online. And so you can see here, we've done a live auction in the past. That was kind of when we first got started. We were doing more live auctions. And then we started working with online auctions. There's, I think, at least 3 online auction companies. We work with Storage Treasures. So in the lower right-hand corner of the slide, you can see an example of some photographs that were taken of a unit, a description of the items that were in there. From somebody who's searching, they could do keyword searching for the items rather than having to show up on a Saturday and waiting for the auctioneer to roll up each door. So this is a far more efficient way of exiting, you know, with an auction.
So let me ask you a question about that, because you're talking about the fact that you're not evicting people right now. So you're, even though it's tough, you're putting yourself on an eviction moratorium during this crisis, but you can still do the overlock, right? If people haven't paid, then they can't access their items.
Okay, again, it's a kind of a state by state situation. We are choosing, and this is by recommendation as of yesterday. This is all timely. Everything is super timely right now. You know,
things are moving so fast.
Everything is happening so fast. So every week we're having multiple conversations with our property managers. It's okay, you know, these 2 states are now on lockdown. You can no longer go and work in the facility. You're going to have to work from home or work by appointment only. And so everything's transitioned. But for right now, the general consensus by the Self-Storage Association in working with these non-eviction mandates, which are very, very vague, by the way. Like, you know, a governor might say no evictions, and they're not even clear if that means no evictions to housing, to commercial tenants. This falls within the commercial realm, but they hardly ever identify self-storage as a tenant type. So, you know, the governors have a lot on their plate. They're making these mandates. They're trying to keep people safe. And so, and also they're trying to keep them from losing money or losing things that create fear, create instability, in disruption in people's lives. And so we have halted late fees, we've halted auctions and lockouts. So people can still get their stuff. You know, technically, I guess they could come in, move out, not pay during the month of April, while sort of this disruption is in place. We hope that there's few people that choose to do that, but we are attempting to abide by these very vague eviction laws and make sure that, you know, people can access their items, as well as being able to interact and help them with online payments, with move-ins, whether that be move into a unit or moving with a U-Haul truck. So we're really trying to provide service to people and be compassionate to the needs of what's going on in the market right now. Yeah, as far as lockouts, there is that question, and I think it's a state-by-state question versus a generalization. So we're just playing cautious on the legal side and allowing people to come in and out.
Got it.
Yeah. Okay, so number 4, less liability. The tenants spend less time on the property because it's not working with them living on the property. They fuss less. They only really get upset when their items start to get auctioned off. And that's really their responsibility for making sure that they're taking care of their bills and being responsible for that. As I mentioned, fair housing laws don't apply, and tenants are responsible for insuring their items. This is actually another line item of income for us. We can require that tenants carry insurance, and then we offer our own insurance program to them. So they can choose to use ours, or they can prove to us that they have homeowners insurance that's covering all of their items. And so that's another way that we reduce our liability. If there's a flood or if there's a pest issue, at least they have insurance that covers those items. God forbid something happened to them. Financing. So our business is a fairly easy business for a lot of people to understand, whether they're private lenders or traditional lenders. Lenders base it off of income, and so they're less concerned about occupancy ratio in some cases. That might be changing because finance markets are tightening up a little bit with their criteria, but in general, self-storage has had a lower default rate than most other asset classes, especially commercial asset classes. And then seller financing is nice. If you can negotiate that with the seller, the seller is likely to be either a company or a family who was used to cash flow, and maybe they just choose not to become an owner anymore. They don't want perhaps the headache of trying to manage a property, but if they can get that check month after month, a lot of times they're really happy to take that. So financing is a lot easier, I've found, with this than, let's say, a fix and flip transaction, or maybe an Airbnb where you might be paying more for a property that wouldn't cash flow to a regular tenant, but you're trying to convince a bank or private money that, you know, you can get extra income off of a special creative way of renting that property. Appreciation is created by an owner adding value to a property that increases its resale value. So when we are buying what's called a value add property, we look for all those ways that we can add extra income, and we do what's called forced appreciation. So there's market appreciation, which is, if you think about the housing market, it's kind of dictated by similar houses, what their sales price is around the neighborhood of which you might have the subject property. With commercial real estate, you're looking at the net operating income of the property. You're looking at the income and expenses. You're looking at ways that you can improve that property. So if you can go in at a specific price, add a ton of value, add extra income, then you can dramatically increase the value of that property. And our number one reason is just reliable cash flow. We can pretty much count on month over month what type of income that we're receiving and paying off to our investors. So here's like a little checklist here. I've got a freebie in on your website there. This is included in that freebie, but it just kind of shows you at a glance, like, when we were evaluating different types of asset classes and creating cash flow for a recession-resistant situation, we were comparing side by side all the different options. So we really saw that storage checked all of our boxes, and we happened to have a colleague of mine that was looking for money, so it was a really nice fit for us. So I'm going to talk a little bit about how to evaluate the property. And we look at the cap rates and we look at the net operating income of a property. So when we're looking at the net operating income, it does not include mortgage loan payments and capital improvements, but it does include the income for rent, late fees, merchandise sales, all that ancillary income that I mentioned earlier. And then the expenses or utilities, property taxes, insurance, maintenance, repairs, your team, etc. And I'll have a couple slides about cap rates, but what you need to know when you're looking at commercial properties is what is the general cap rate in both the area that you're in, the class of properties. So there's Class A, Class B, Class C properties. Class A are like, you know, really nice new properties. Class C are kind of like, they're a little on the fringe, right? So the class of the property and location of the property. So what did I say? Location, the class, and also the asset type. So different asset types in different markets have kind of different rates. So typically industrial is a higher cap rate, meaning that you're going to pay less for your cash flow than, let's say, an apartment complex. So if you look down at these examples, property one has an NOI, a net operating income of $90,000 and a sales price of $900,000, that produces a cap rate of 10%. And you can kind of look at these other examples. If the sales price for that property was 1.8 million, it would be a cap rate of 5%. And that's kind of what you would see in coastal markets like California, for example. You might see cap rates closer to 5 or 6%. So here's an example of cap rates around the country. This was taken a couple of years ago, but this has pretty much remained steady, at least to this point in where we are in the market cycle. If you go back maybe to the early 90s, you would see cap rates that are much higher than this. So again, the asset classes, primary markets, tertiary markets, secondary markets, they all have a little bit of a variance. And I should just mention Marcus and Millichap has a lot of really, really good marketing data that they provide to really whoever needs this information, who wants this information. You can sign up and get all kinds of charts and graphs specific to a market, as well as different types of asset classes. I just pulled this slide here, and you can see the cap rates versus the 10-year treasury. So one big headline that's been in the news over the last few weeks is the 10-year treasury dropped almost down, like I think half a point. But the cap rates are remaining steady. So that gap has widened a little bit. And I think, this is just me thinking this, if the 10-year treasury stays as low as it is, but there's fear in the market, I believe that the gap, so if you're looking at the spread here, that's the red line that you're seeing on this chart, the gap will probably increase, but I also believe that the cap rates will remain steady as long as that treasury rate remains as historically low as it is today. And so when people are worried or maybe hopeful that the prices of properties are going to drastically increase in the commercial sector, decrease so that they can get something on a fire sale, I don't necessarily think that's the case. I think that, again, they're going to look at how much income that property is pulling in, and that's where you're going to see the discount. It's going to be based on the cap rate. So if that property suddenly has lost a bunch of income, you're going to evaluate it accordingly. It might have been $2 million yesterday, and it might be worth $1.5 million in a few months. That's going to be more dictated by its income and its bottom line that it's showing over the last, period of months since we've had this shutdown of America and the coronavirus and everything. So hopefully that makes sense. And I'll just pause. Monique, do you have any questions about that or thoughts around that?
Yeah, I mean, that's going to, so with commercial properties, as Alia was explaining, the value is based off of the net operating income. Because of this historic shutdown in the economy, I mean, it's a lot of businesses have just come to this grinding halt. The NOI is going to go down. So they're not able to make sales. They're not able to, so the income's going to go down, which affects the value. What will remain, and so which will impact the price. So what will be interesting to see is, will sellers, how are sellers going to deal with this situation? Some people who had properties on the market are pulling them out and deciding to hold on to them until they can get the NOI back to a more normal part. Some people can't. So I think there will be, sales because of people who need to sell for whatever reason, and the values, the NOI will have gone down, so the prices should go down accordingly.
Right.
Yeah, the cap rates might adjust though, so it might not be like so the cap rate might go down a little bit to, people might be willing to pay, might factor in that, okay, this income, what's happening right now is not typical, and so they might look more broadly at income as opposed to just looking, maybe at the T12, the last 12 months, and they might look more broadly to average out, but we'll see. I do believe though there will be opportunities coming up.
Yeah, I definitely think there will be opportunities coming up. There's a number of different, at least in the commercial sector, asset classes that are going to be so hard hit that the recovery is not going to burn if suddenly everyone goes back to work and engines fire up again. I have a feeling there's going to be almost a societal shift in how we go to work. Office spaces in particular, I think will be interesting to see. Not only will some companies not make it, they might have furloughed people, they might have let people go. And so I think that's one asset class where you're going to see some discounts. I think in the retail sector, same thing. Malls, entertainment, those are areas where I think you're going to see the deeper discounts and a deeper dip and potentially a longer term uptick. Self-storage, I'm pretty confident will remain roughly the same. I think the difference is in the financing. So when we had this Marcus and Millichap commercial real estate meeting attended by about 10,000 people a few days ago.
Wow.
There was a lot of interested parties, right? So Marcus and Millichap really provides some great information. They pull the top people in really looking at the market. And what they said was, one, there's an infusion of a lot of money that's going into the market right now. And so that should buffer some of the fall.
The trillions of dollars from the government.
Yeah. We're printing money like it's going out of style.
Yeah.
That is going to help. For self-storage, I believe that's going to help our tenants a lot, because if they're getting a stimulus check of $1,200 or, maybe more if it's a household with children, that's going to help them pay their basic bills. And I think that's going to help them pay their storage bill. Where you might see a bigger lag is if the company itself that they're working for doesn't get back to where it was before, and then they experience layoffs. So I believe it remains to be seen, right? Like, we don't know how long the shutdown is going to continue, and we don't know the psychological effects of the shutdown, how people are going to behave when they are able to go back to work. So no crystal ball here, but I think we have some time to find some opportunity.
Yeah, agreed.
I mentioned this before with the difference between residential and commercial properties. With commercial, we base things on the net operating income. With residential, it's local comps. And I'm just going to jump through these slides here because I've kind of already explained this. But I'm going to go into a case study with the first deal that Carrie and I did with Al, and that was Owasso Mini Storage outside of Flint, Michigan, where the population is roughly 100,000, and we'd like to see at least about 50,000 population within a 5-mile radius. Owasso itself is more of a rural area. It's got about 30,000 within that 5-mile radius, but it's pretty much one of two games in town, right? So there's only 2 self-storage facilities in this area at the time of purchase. So we were really at an advantage there. Wasn't a lot of competition. We had roughly 300 units between parking and actual storage units. Plus we had 3 apartments and a dance studio. And currently where I live in San Diego, the average single family home is what we paid for this entire property for. So we got a massive discount on this. We were able to take over basically the property for what they owed on it. We went to a commercial lender. We got a 65% loan to value ratio on the purchase, and that covered the majority of it. And then we came in with our own capital, working with ourselves and a couple investors. And the occupancy rate was 67. That's jumped up considerably since then. We did some initial basic repairs, the apartment roof, fixed the gate, cleaned up the yard and the weeds. Again, the yard and the weeds, like that seems like a no-brainer, but a lot of sellers are so tired, they don't even make the property look nice. They don't even take a weed whacker to it. And this just was the thing that made it look tired. It made it look, you know, like people just didn't want to rent there because it was unkept. So that was an easy thing to fix. We improved the signage. We put the word storage on the sign and a phone number. Again, simple things. But if you're driving by and now you see, oh, there's a storage facility back there behind the apartments and behind the dance studio, and a phone number that's actually visible to drive-by traffic, that helped get the phones ringing. So that was good. We extended our hours to include the weekends. So we hired a part-time manager. We added a call center that was available 24/7. We added the U-Haul truck. So again, that name brand recognition with the flags outside and the trucks outside. Boxes, packing supplies, and we started advertising to RV, boat, and vehicle rentals, whereas we had probably at least an acre of property that wasn't utilized for this purpose. So we were able to increase our revenue by bringing in a few dozen vehicles. That was great. And here's just a sample of the numbers. So the occupancy rate was 67. We brought it up to 92. The NOI nearly doubled, and the appraised value increased dramatically. So when we purchased it, it was an 11 cap. And I think the valuation, when we went to our lender, they evaluated it based on a 7% cap rate, which was more in line with the market. So looking at this, the appraised value went from, you know, our purchase price of $635 to $1.9 million, and we make some steady cash flow off of that goes into our pocket every month. And this is one of our exciting properties that we've had. Now I'll jump into, is it a good time to buy? So we've seen industry shifts in major MSAs. The developers have built a record number of storage facilities over the last 3 to 5 years. So that creates a major oversupply in some markets. Again, this is something that you almost have to evaluate within a 5-mile radius of the property. You could be in Dallas or Sacramento, which has been overbuilt. But if you're at a part of town within that 5-mile radius, there's no competition. Then it might still be an okay play. We focus on secondary and tertiary markets, and even within the conferences that we've attended, that's where they've also shared where they saw the opportunity being. The current need is strong, but it's been shifting substantially, right? So we've had a weakening of the economy. Millennials are renting apartments with limited space. The boomers are downsizing into smaller homes. And so you really have to look outward towards the long term. Interest rates, what's working for us right now? Interest rates are rock bottom. Financial markets, they are still lending, especially if you look for SBA loans. SBA loans are still available, and as you know, it's been in headline news. If you haven't heard about SBA programs, they're really, really helping out business owners across the country right now that are.
We had one of our CPA talked all about it. So we had a conversation about the CARES Act and what are
good.
A lot of the goodies that are in there for real estate investors.
Yeah, so I'll skip over the details of that and just point back to whomever that speaker was so that they can share all that data. I mean, it's really valuable data. And if you haven't heard of these loan programs that are out, as a business owner, definitely check them out. It's very, very timely. It's kind of a first come, first serve basis, so you want to get your applications in if you can. Major hedge funds and portfolios have slowed or stopped their purchasing for the time being. And so you really have to be cautious and make sure that the deal makes sense as the property is performing today, and even perhaps hedge for a slight downturn depending on how well the property has been operating up to this point. If the property is already optimized and running with good marketing, good management, then it might have a harder upside, harder way to have the upside than if you have a property that's totally undermanaged, not being marketed at all. Then there might be some opportunity to add value into the latter. What I feel that you need to do right now is you need to build a cash reserve. Make sure that on a personal level that you have at least 6 months of liquid savings for just basic survival. Because again, we don't know how long this downturn of the economy, people's job loss, et cetera, is going to last. So make sure that you have your basic needs met. And then gain access to credit. If you haven't done this already, make sure that you've got lines of credit, credit cards, HELOCs. This is advice that I rarely give to people about accessing credit, getting credit cards, lines of credit, but just having that peace of mind that you have money available to you in different forms, I think is really going to be important right now. Doesn't mean that you have to use it, but having it available to you, I think, is important. You know, I have excellent credit, but I just reviewed my credit online, and some of my creditors, like Lowe's, for example, they shut off my card. So this is what's happening for absolutely no reason other than I probably haven't used the card in a while, but this is happening across the board where the credit companies are shutting people's credit off. So you want to make sure that you have, if you've got, you know, one credit card, maybe get one or two more if you think that you're going to need that. Access to assess your accounts where you have the ability to withdraw money without a penalty. So right now, if you pulled a certain amount of money out of your IRA account, the penalty on that is being waived for the time that we're in at this moment. Same thing with CDs and insurance plans. Maybe evaluate if you've got the ability to pull money out of those if you absolutely needed to, or if you saw a deal so amazing that you feel it warrants pulling your money out of something else. Take action on available money such as the tax refunds and the stimulus checks that are coming out. In some cases, you might have to do nothing at all, but if you've got refunds that are owed to you, definitely get your taxes done and make sure that your information is updated for your stimulus checks. You'll want to, if you can, diversify your income sources. So if you don't already have a side hustle, you might consider having one now.
Like real estate investing?
Like real estate investing. Or you also want to think about, like, are all your eggs in a similar basket, right? You want it to make sure that if you, let's say, for example, you're an Airbnb person, right? And you're probably getting hit a little harder than most people right now with that particular type of asset class. You might want to consider using your money, if you've got extra money set aside, maybe doing a private loan on a first position note or some other way to diversify your income. Maybe it's doing a side hustle on Amazon.com. There's lots of ways to make money, but if you can make your money from a few diversified streams of income, that's probably better than having everything in one basket, unless that one thing that you have is working so well for you that just keep rocking with it.
So it's always a good idea to have uncorrelated streams of income.
Exactly. Yeah.
The diversification is a good thing.
Diversification is great. If you can, apply for the SBA economic injury disaster loans and the payroll protection plan or payroll protection program funding if you qualify for that. And then dust off your personal financial statement. Just do an overall look at where you stand And a lot of those things that I just mentioned will fall under your personal financial statement, but just really figure out kind of where you stand right now. And if you need to do some tweaking and tightening up with how your money is being held, do it now. The second thing is create relationships with people. If you are a real estate investor, you want to build those relationships and deepen the relationships that you already have. And the people in your network, if it's, you know, buyers and sellers, if you're flipping properties, if you're somebody within the commercial arena, you might want to be reaching out to your brokers and your title companies and escrow companies, finding motivated sellers, talking to your sources of private money. Maybe you've had a number of real estate investors that you worked with in the past. Figure out where everyone's at. You know, some people might be excited to jump into this market. Other people might be scared. You might want to get a temperature on the people that you work with as money partners. And then consider mentors and masterminds. Follow people that are actively doing deals, that are keeping a level head and positive outlook on what's happening right now, because those are the people that you're going to want to surround yourself with when the market starts to recover and opportunities start to flood the market. So where I see the deals on the horizon is going to be pocket listings with agents and brokers. Sometimes, especially commercial properties, sellers don't always want their property to be listed on the open market. Sometimes it freaks out their managers, sometimes it freaks out their tenants. Sometimes they're just embarrassed for some reason. That one I don't really quite understand, but they'll talk to a broker who has good relationships with a lot of potential sellers, and as a buyer, you might be able to get that pocket listing. Deals falling out of escrow. So I mentioned title agents, escrow agents. That's where you could find some deals. If you're specific to self-storage and wanting to get into this particular asset class, attend the conferences. You're going to meet a ton of people, buyers, sellers, people who do repairs on the properties, people who have reporting capabilities, online marketing, and brokers. So attend the conferences for the asset class that you're interested in. And then auctions are also going to increase, I think, as we get more motivated sellers and maybe banks taking properties back. So 10X is just one.
We are running out of time. So I want to make sure that, you know, maybe we can share these slides with people sure. If there's a lot of really good information. And we're about to get into our next conversation, so I just want to like wrap this up.
I think this is like my second to the last slide.
Okay, so I think the last slide was just your contact info.
Yeah, contact info, what we offer. So I'll just kind of generalize. Seek attractive financing terms. I've got, you know, SBA commercial rates that are low, small business development centers, seller financing. If you could ever get seller financing, now is a great time to be looking at those. And then here's what we offer. We have a self-storage training program, and I think you can learn more about that through your website, Monique, is that correct?
Yeah, we'll have a link for that.
Okay, so we'll have a link for that. And then if you want to contact us, you can reach us through either website, through investorsinaction.com or Capital Storage Fund.
All right, thank you so much. So before we go, I just wanted to ask, how are you dealing with the psychology, because there's a lot of fear and things are unprecedented right now. So how do you keep yourself in the right frame of mind these days?
Well, I guess I'll start when I had that kind of like the freak out. I'll be honest, like when we started seeing shutdowns, right, where people had to stay at home and the mandate, I took that seriously. And I have an older stepdaughter who is living with 5 roommates, and they're still going on Tinder dates, or at least they were at the time, so depending on my sphere of people, I wanted to make sure that the people closest to me and the people who are going to interact with my infants were staying safe and following all the guidelines that are issued by the government. So it's just really is staying safe and taking all of that seriously, and making sure the people I'm surrounded by are taking that seriously. And you know, my husband walked me through this. He kept saying, what are you afraid of? What are you afraid of? And we kept going deeper with that question. You know, am I afraid of dying? Not really. You know, obviously I don't want harm to come to my children, but are they at a high risk? Not really. So I think it was just doing that deep inner work and really deciding, you know, like, what is there to be afraid of? Okay, now what can I control? What are the things that I can do to make sure that I'm being safe, that the people I love are being safe, and just recognize I've done everything I can do. I'm taking all the precautions. I'm wiping things down if I go to the store, which I haven't, but you know, if I'm doing that, then I'm maintaining my distance and just trying to take all the precautions that I can in this particular environment. And I'm in a way excited by the challenge that's in front of us, right? I like a good challenge. So I've shifted from fear mode to how do I help people and how do I solve problems and how do we get through this as a company, as a team, as a family. And so we're really just focused on positive ways of interacting, making sure that our communication lines with our investors and our tenants and managers are good, that you know, we're reaching out to people that we care about. And so that's really the main way that we're staying sane.
Yeah.
Lots of Zoom calls, lots of interaction this way with people.
That's so good. Thank you. I mean, that's great. Just sort of like really get clear on like what is there to fear and to control what you can and let go of the rest. So yeah. I love that. Thank you so much for taking the time to be here with all the craziness going on. I so appreciate you, and this was awesome.
You're absolutely welcome. Thank you, Monique, for organizing this, and I'm excited to learn from all the other ladies that you have. So
awesome.